Today on Inside the Issues, I speak with Paul Bluestein about his new book, Off Balance, The Travails of Institutions That Govern the Global Financial System. Hello, and welcome to this week's edition of Inside the Issues, a CIGI online podcast. My name is Dr. Andrew Thompson. I'm an adjunct assistant professor of political science at the University of Waterloo and program officer at the Balsley School of International Affairs. Today, our guest is Mr. Paul Bluestein, who is a CIGI Senior Fellow. He's an award-winning author and journalist, and he is with us today to talk about his new book, Off Balance, The Travails of Institutions That Govern the Global Financial System. Welcome to the show, Paul.
Thank you very much. Nice to be here.
I thought we might start the interview by giving our audience an overview of the global financial landscape. Very briefly, can you talk about the key institutions that we have, what roles they play in governing the global financial system?
Well, there are four big ones. One is, and two are particularly well known. One is the International Monetary Fund, the group of 20 major economies, which has, the big leaders summit every year. And then there are two that are not so well known. One is the Financial Stability Board, and the other is the Basel Committee on Banking Supervision. They're both based at the Bank for International Settlements in Basel, Switzerland. And these institutions didn't all come into being at one time. The IMF was sort of famously created after World War II, when there really wasn't a global financial system in any real sense. The founders of the IMF, John Maynard Keynes and Harry Dexter White, who was the Assistant Secretary of the Treasury for the United States, wanted a system in which a lot of money didn't slosh across national borders. They thought that had contributed to the Great Depression. So they wanted an institution that would keep currencies fixed and would keep money, and money wasn't really supposed to go flying all over the world as it does today. But then that system broke down in the 70s, and then they began to worry about problems at banks in one country spilling over to banks in another. So then the Basel Committee on Banking Supervision had to be set up to deal with that problem. And also when currencies began gyrating all over the place because so much money was going from one country to another, then they had to set up, and then the group of five, as it was then known, soon to become the group of seven when Canada and Italy joined, and later now the group of 20 today. They had to deal with trying to work out some types of agreements to keep currencies from getting too strong or too weak. And then after and then so much money was flying into the developing economies of the emerging world in the 90s, when those economies began to flourish. But then too much money flowed in, and then too much money suddenly flowed out, and they had big crises in Asia and in Russia and Brazil and Argentina. So the Financial Stability Forum was then set up. It is now that I mentioned the Financial Stability Board. Now, at that time, it was called the Forum. But anyway, it was set up to try to mainly with the purpose initially of dealing with problems in those emerging economies, the sort of the fast-rising economies of Asia, Latin America, Eastern Europe, and so forth. So those are the four big institutions that we've had, and they've sort of, as the world economy, as the financial systems become more global, we've set up more and more of them.
Right. Now, in your book, you note that many of these institutions either failed to predict the financial crisis of 2008, or they didn't take the warning signs that they did identify seriously. And why was there this collective failure in your mind?
Well, one thing I want to emphasize is that it's not because they're stupid. I mean, these are very smart people. There's a few exceptions, maybe who don't maybe not bowl you over with their brilliance, but most of them are very, very smart, very able, very dedicated, really trying to make the world a better place. So if all we had to do was replace incompetent policymakers with competent ones, we wouldn't have these. We wouldn't have such a daunting problem in dealing and policing the financial system. But part of the problem was with my native country, the United States. The Bush administration and the Federal Reserve were dominated by people who believed what has been sort of mocked as market fundamentalism. The belief that markets will take care of things, that CEOs of banks can be depended on to avoid taking imprudent risks with their shareholders' money, because after all, that'll be bad for them in the long run if they do. That, of course, assumption turned out to be terribly flawed. But you can't just blame the United States. Part of the problem is that modern financial markets are so complex, and the interlink. This is not a particularly novel observation, but they are so complex, so difficult to figure out where the vulnerabilities are. That these people were looking. They were looking everywhere. They were looking at avian flu epidemics. They were looking at the collapse of global trade talks. They were looking for what if we have a terrorist event. Like as we did in 2001, and that creates problems for finance. So they're looking everywhere, and they did see that there were problems in mortgage markets in the United States, which is where the problem really sort of originated. But they thought, well, that's just a small part of the mortgage market, and they sort of believed the argument that was coming out of the U.S. And the Federal Reserve that these problems were small. So. It wasn't that they weren't sort of scouring the landscape, looking for problems. They had been set up after the Asian crisis, the emerging markets crisis of the 90s, to do that. But they were sort of looking everywhere and yet nowhere.
Well, thank you very much. We'll be back in a moment with Paul Bluestein. You're watching Inside the Issues, the CIGI Online podcast. Look for us at cgonline.org, on Facebook, on Twitter, and on YouTube. Welcome back. Paul, I'd like to pick up on our last discussion. And one of the points that you make throughout the book is that within some of these institutions, there's a culture in which top economists and officials are sometimes afraid to speak truth to power. What led to this climate in these institutions in the first place? Is there anything that can be done about it, and what are the real governance implications of this kind of environment?
Well, one of the big problems is that not only are they afraid to speak truth to power, they're afraid to speak truth to each other. A lot of these institutions are, the governing bodies are people from various countries. Sometimes they're very powerful countries, the U.S., China, European Union, Japan, and so forth, and they're afraid. And they're one of the observations that one of the people I talked to made about the way the problem in the he worked in the Financial Stability Forum. He called it great defensiveness and excessive politeness, and that's just sort of it's great that these people get together for these meetings. They get to know each other, and so when a crisis comes, they can call each other on the phone, and they're comfortable with each other, but it's just natural human nature when they're in a meeting room. And they think, gee, I really ought to point the finger at so and so because I'm worried about something in his country. They're, it's kind of natural. First of all, I've gotten to kind of like that guy, or even if they don't, they're worried that, well, if I point the finger at him because there's a bit of animosity between our governments or whatever, then maybe he'll point the finger back at me at the next meeting. And I should say he or she, because there were quite a number of very able female policymakers on these bodies as well. So, so this is one of the problems with this type of international governance is that instead of mutual surveillance and mutual peer reviews, which is what is one of the goals of these sorts of bodies, to get countries to put pressure on each other to do the right thing for the sake, not only for their own sake, but for the sake of their neighbors in the world economy. They turn into kind of mutual protection societies.
Right. You also note in the book that states will always look after their own interests first over the good of the collective. And we've seen in a number of cases where this type of nationalism can actually not only inhibit international cooperation, but can actually exacerbate a problem or a crisis. Is there any way around this? or is this just the reality that we are living in a world where financial nationalism is the dominant norm?
Well, you can't expect countries to act against their own interests, for sure. I mean, it's a definition of what you mean by their national interests. I mean, countries certainly, in terms of what the long-run interests of their people, they're not going to sacrifice for the sake of other countries. But there are many cases where there are actions they could take that would be in their own people's long-term interests and would also help promote global growth or global stability, but which the governments are very reluctant to take because of political pressure from some group. A good example would be Chinese, arguably should have let their currency rise a lot faster. It would enhance the ability of their people to enjoy a better living standards, but very powerful exporters in their country didn't want to do that because they were afraid that would hurt their profitability. And the government was afraid that this would lead to some unemployment, and so they were very reluctant to take a short-term, painful step for the sake of the long-term good of the country, but which could have helped promote global stability in the long run. And what you can do about this? Well, I mean, what I argue in the book is that, and what I believe is that unless you have neutral umpires that countries can kind of trust to make unbiased judgments about these kinds of problems, then it's going to be very difficult to overcome them, because countries don't like being told by other countries what they're supposed to do. So if you have neutral judges who people think are genuinely acting in trying to take the global interest into consideration, maybe you have some chance. The problem is you can't get countries to submit to that type of judgment either. So I'm not terribly optimistic.
Right. Thank you very much, Paul. We'll be back in a moment. You're watching Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. Paul, I'd like to use our third segment of the interview to talk about the U.S.-China relationship and this part of the story. China and the U.S. have been engaged in a protracted disagreement over the value of the Chinese currency. The IMF has been one of the battlegrounds for this currency war. You have a wonderful chapter in your book on the fundamental misalignment controversy. Could you share that with our audience?
Here the idea was that the IMF was going to be a kind of a neutral arbiter and decide which, and if they thought that a currency, like as China as being the kind of the most obvious case, if it was fundamentally misaligned, that they would call that country out and do a bit of naming and shaming in a sense. This was one of the, when John Maynard Keynes, he had this famous term, ruthless truth-telling, when the IMF was created at the Bretton Woods conference in the 40s. He wanted the IMF to be a ruthless truth-teller. So now the U.S. government was very excited about having the IMF do this kind of thing. They wanted to have this big international institution point the finger at the Chinese. Some people at the IMF thought, well, there is something to this. I mean, this is in our tradition that we're supposed to have of ruthless truth-telling. We should, yes, we should. But there are we should also. There was another great principle of Keynes, which is he wanted the rules to be applied symmetrically. He wanted them to be applied to surplus countries, deficit countries, big countries, small countries, everyone. So the IMF would be, again, this ruthless truth-teller. And the people who were pushing this idea at the IMF said, well, let's have a rule that might very well apply to China, and we'll call a currency fundamentally misaligned if we think it is. But let's apply it to all countries, and perhaps we ought to include the U.S. Well, they tried to apply it to the U.S., but there were objections raised. Well, and again, the U.S. wasn't fundamentally misaligned in the sense of its currency was too cheap. The argument was the U.S. dollar is fundamentally misaligned in the sense that it's overvalued. It might crash because of all the overconsumption, all the problems we're familiar with the American economy. Anyway, long story short, that just didn't fly. Partly because they just couldn't speak. To come back to your point about couldn't speak truth to power, I think that was a big part of it. Then they looked at the currency of the Maldives, this tiny little country, and they couldn't even speak truth to non-power because they felt sorry for this tiny little country and didn't want to call them fundamentally misaligned. Then along came China. The big decision was, will we have the guts to call the Chinese renminbi, their currency, fundamentally misaligned? And there was a staff report drawn up, which I quote in my book, and an executive board meeting of the IMF was scheduled for September 22nd of 2008. But if you remember your history, that was 1 week after the Lehman Brothers bankruptcy. Now, of course, the meeting was scheduled before the Lehman Brothers bankruptcy. Right. When the Lehman Brothers bankruptcy occurred and the U.S. was suddenly on its knees begging the Chinese for help, and it was like, okay, we'll forget all about this. And the IMF said, yes, let's not have the Chinese get mad because we really need them to get over this crisis that we're having. And that report, which I quote in the book, was just buried, and the meeting was never held. And that was the end of the story. And so the idea of symmetricality, prevailed. Nobody was labeled fundamentally misaligned.
Right. You do mention in the book that the power dynamic between the U.S. and China changed after the 2008 financial crisis. What was it like prior to the crisis? How is it different now? And what are the implications for the international financial system?
We go back to just a little more than 10 years ago in the late 90s when we were talking earlier about the Asian crisis, and there was this famous Time magazine cover showing Alan Greenspan, Robert Rubin, Lawrence Summers of the U.S. Treasury and the Federal Reserve on the cover, the Committee to Save the World, and the line about them was they were really running the effort to save the global economy by telling the IMF what to do. And this is the way a lot of international economic institutions have been run in the post-war period. The Americans have basically called the shots, and they've gotten a lot of benefit from that. There've also there's certain burdens of this kind of hegemony that America has exercised. But anyway, it's redounded to America's benefit in many ways. In this case, after this crisis came, it's very clear now. I mean, I think that decision we were talking about earlier about fundamental misalignment, that really showed that there will never be another case like that where the United States will be able to just throw its weight around without getting the assent, at least, of the Chinese authorities. The Chinese aren't going to be the Committee to Save the World. They're not going to be the guys calling the shots. They're not ready to do that yet. The United States is still more powerful, but it isn't able to throw its weight around in the way that it was before.
Thank you very much. You're watching Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. Paul, for the last segment of the interview, I wonder if we could go back to our discussion of the institutions themselves. And at the end of the book, you make it very clear that you think these institutions, whether the IMF, the Financial Stability Board, or the Group of 20, are still not up to the task of governing the global financial system. In your view, where are the gaps that still exist, and what can be done to fill them?
Well, a lot's been done. I mean, of course, the crisis, really put the fear of God into everybody, and they went to work immediately. The G20 was formed to replace the G7 as the sort of steering committee for the global economy. It was a very good thing. The Financial Stability Forum was given a bigger mandate and a new name, the Financial Stability Board. Those names are very similar, and that reflects a lot of similarities between those institutions. But it was given a bigger mandate. The IMF was given much more resources, double, trebling of resources. We have all kinds of new bank capital rules that are, because the rules they were called Basel II, the Basel Committee on Banking Supervision had these rules called Basel II. They were improved to Basel III, And again, you can't argue that they're going in the wrong direction. These are all in the right direction of trying to make the system better. But there are two fundamental problems with these institutions, which I identify at the beginning of the book, and which I come to the conclusion, with some regret at the end, that I think these gaps still remain. One is that these institutions can't, amid all the bewildering complexity of modern financial markets, identify where the big vulnerabilities are. And that makes it very difficult to devise the right kind of rules for international cooperation for making the system more stable. And the second point is that they don't have the power or the will to really stop countries from taking actions or from adopting policies that may be harmful to their neighbors or even to the system as a whole. Again, they've gone a considerable way toward trying to rectify some of these problems and to try to make the system work better. But I think those fundamental weaknesses they're very just incredibly difficult to overcome. We have a system of sovereign governments and global capital, and until that changes, which I don't see a whole heck of a lot of prospect for, I think we're going to still have those gaps, those vulnerabilities.
Sure. To wrap up, if there were one or two things that you want your readers to take away from your book, what might they be?
Well, the first is sort of a point that I know a lot of the expert viewers will consider sort of obvious, which is that we don't have the international institutions we need to govern the global financial system. That may become painfully evident from the crisis we had. I guess what the book does is it kind of says, it's even worse than you thought. I mean, if you want to really look inside these institutions, what I do in the book is of course, I interviewed a lot of people to find out what happened, and I also persuaded some of the sources I interviewed to give me a lot of the confidential documents that, these go back some years. So in the interest of historical accuracy, they were quite willing, they were willing to part with them and let me see them. And, when you look at what was going on inside these institutions, you can see, as I say, that although it may be obvious that they weren't up to the task, it's even, if you really want to see how weak and so often feckless these institutions are, you really have to look at them up close, and it'll really stick to your ribs when you, so to speak, when you see that.
Right. Wonderful. Well, thank you so much, Paul.
Thank
This has been
great to have.
lots of fun. Paul Bluestein's new book, Off Balance: The Travails of Institutions That Govern the Global Financial System, published by the Center for International Governance Innovation. So thank you very much, Paul.
No,
thank you
pleasure.
to our audience for joining us. Please join us again next week for another episode of Inside the Issues, CIGI Online podcast. Look for us at cgonline.org, on Facebook, on Twitter, and on YouTube.
Money and money wasn't really supposed to go flying all over the world as it does today. But then that system broke down in the 70s, and then they began to worry about problems at banks in one country spilling over to banks in another. So then the Basel Committee on Banking Supervision had to be set up to deal with that problem. And also when currencies began gyrating all over the place because so much money was going from one country to another, then they had to set up, and then the group of five, as it was then known, soon to become the group of seven, when
Today on Inside the Issues, I speak with Paul Bluestein about his new book, Off Balance: The Travails of Institutions That Govern the Global Financial System. Hello, and welcome to this week's edition of Inside the Issues, a CIGI Online Global Financial Landscape. Very briefly, can you talk about the key institutions that we have, what roles they play in governing the global financial system?
Well, there are four big ones. One is, and two are particularly well known. One is the International Monetary Fund, the group of 20 major economies, which has, the big leaders summit every year. And then there are two that are not so well known. One is the Financial Stability Board, and the other is the Basel Committee on Banking Supervision. They're both based at the Bank for International Settlements in Basel, Switzerland. And these institutions didn't all come into being at one time. The IMF was sort of famously created after World War II, when there really wasn't a global financial system in any real sense. The founders of the IMF, John Maynard Keynes and Harry Dexter White, who was the Assistant Secretary of the Treasury for the United States, wanted a system in which a lot of money didn't slosh across national borders. They thought that had contributed to the Great Depression. So they wanted an institution that would keep currencies fixed and would keep.
Podcast. My name is Dr. Andrew Thompson. I'm an adjunct assistant professor of political science at the University of Waterloo and program officer at the Balsley School of International Affairs. Today, our guest is Mr. Paul Bluestein, who is a CIGI Senior Fellow. He's an award-winning author and journalist, and he is with us today to talk about his new book, Off Balance, The Travails of Institutions That Govern the Global Financial System. Welcome to the show, Paul.
Thank you very much. Nice to be here.
I thought we might start the interview by giving our audience an overview of